high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we explore the stories behind key banking sector developments. It is the 30th of November 2023. I'm Swapnil Joglekar, and this is what we have lined up for you today. First up, our cover story will discuss the RBI's new approach to penalties. In Banker's View, Manoj Nambiar of Arohan Financial Services talks about the lending scenario for the microfinance industry. In Banking for You, we will tell you what risk weights are. Then our consulting editor Tamal Bandyopadhyay joins us to share his views on long-term government bonds and more. At the show's end, we share the results for last week's poll and the question for this week. All this in today's edition of the Business Standard Banking Show. RBI Governor Shaktikanta Das met the boards of state-run and private banks in May, and a new penalty regime is now understood to be in the works. What is it? What will be the impact? And what was the need for this proposed change? Raghu Mohan brings you the answer.
The Reserve Bank of India is working on a new framework for penalties on regulated entities or REs, which are all the entities that report to it. Not only are the amounts to be imposed on these REs to be increased, but they are also to be linked to the size of the entity, with key management personnel also on the regulatory radar. This new approach is part of the central bank's moves to improve corporate governance standards in REs. It follows RBI Governor Shaktikanta Das' meeting with the boards of state-run and private banks on 22nd and 29th of May, where he raised issues related to governance, ethics, the role of the boards, and supervisory expectations. The new penalty framework may see a clawback of the payouts to chief executive officers and key management personnel. In the case of state-run banks, remarks made by the RBI's senior supervisory manager on the key management personnel could decide how they progress in their careers.
I think we should, going by the way regulators across the world are looking at the enforcement, there's a need for, I would say, recalibration of the whole enforcement structure, which involves penalties. Right now, the penalties are more monetary in nature, but it's time now to look at non-monetary penalties too. Non-monetary penalties could mean restrictions, business restrictions, could mean impact on remuneration of material risk takers or senior management, including the CEO. It could be a capital charge, additional capital charge. It could mean clawbacks. So it could mean also world over people are looking at disgorgement of gains made from the offense. So RBI can even look at that as part of the wider ambit of enforcement regime.
In FY23, there were 211 instances of penalty imposition, totaling 40.39 crore rupees. In FY22, there were 189 instances with a total penalty imposition of 65.32 crore rupees. In FY21, the RBI imposed penalties worth 31.36 crore rupees. Compared to the penalties imposed globally, which run into hundreds of millions of dollars, the amounts imposed by RBI are small. The highest penalty by RBI to date is 58.9 crore rupees imposed on ICICI Bank in March 2018 for its failure to adhere to directives regarding the sale of securities from its held to maturity portfolio. The major reasons for the imposition of penalties on regulated entities were contravention of Section 26A of the Banking Regulation Act 1949, cybersecurity, non-compliance with exposure and income recognition and asset classification norms, Know Your Customer Directions 2016, fraud classification and its reporting, submission of information to the Central Repository of Information on large credits and to credit information companies. Customer protection, limiting the liability of customers in the cases of unauthorized electronic transactions. Director-related loans, monitoring the end use of funds, and violation of Housing Finance Companies Directions 2010. The new framework will require REs to be conservative. Consequently, being an outlier on regulatory issues will affect both capital and human resources.
So, not following regulatory directions will impact the business of regulated entities. Another sector in the spotlight is the microfinance sector, as signs of stress are showing up even as rural demand slackens. My colleague Raghu Mohan caught up with Manoj Nambiar, the MD of Arohan Financial Services, to discuss this. Here's the chat.
Welcome to the BS Banking Show, Manoj. Good to have you. How does the MFI sector look at this stage with talks of enhanced stress and weak rural demand?
Yeah, so Raghu, as I mentioned earlier, the microfinance industry operates in a slightly different space. As you know, the segment is defined as households with annual household income of less than 3 lakhs per year. And to that extent, given the new underwriting norms, given the new income limits, given the fact that we cannot leverage the family more than 50%, all of us are today far more rigorous in terms of the credit assessment which is done before we give the loan. And as you know, there's a very strong credit bureau discipline with 4 credit bureaus tracking each loan that the customer has taken from any RBI regulated institution. So to that extent, I would say that lending has become far more conservative given the annual household income assessment and not leveraging the family more than 50%, apart from all the ground level checks which are done before the loan is given. We do see a slight uptick in terms of the delinquency, but that is something which I think is the after effect of what has happened in the COVID pandemic. So to that extent, the new portfolio which is being written after wave 3 is actually performing better than or equal to what it used to be pre-COVID. But definitely caution in terms of the underwriting norms and the fact that we need to be far more careful, given the fact that while this is a group lending, it is essentially unsecured from that perspective.
RBI has red flagged its concerns on unsecured lending. How does that play out in the MFI space?
Well, the good part, Raghu, there is that if you read the announcement, it is bank loans to NBFCs which do unsecured lending, which essentially has come under an additional risk weight on the capital adequacy. Now, 2 particular entities have actually been exempted there. One is MFIs, which is people like us, and second is housing finance companies. So given the fact that both of these 2 are priority sectors in terms of lending, the RBI is very keen that fund flow to this particular sector is not constrained. And to that extent, I would say that we are lucky that we have been exempted from this particular additional risk weight. So we do not expect any change in the interest to lend to us. And needless to add, each one of us negotiates the price at which we borrow, because that is an important ingredient to the final pricing that we charge to the customer.
Many political parties in recent times, now that the poll season is on us, have raised the issue of loan waivers. Is that a cause for concern?
So Raghu, elections in our country keep coming and going. So we have state elections, we have corporate elections, we've got national elections, and to that extent, all of us, I would say, have understood the ways to sort of manage the entire process. The good thing, Raghu, is that not a single political party, even in the state elections or the city elections, has ever spoken about waiving microfinance loans. Right? There is a lot of chatter, a lot of noise, a lot of buzz around the agri loans, because those are the sectors which essentially go through a little bit of stress. And to that extent, customers who've taken those loans need either interest subsidy, maybe a partial relief in terms of interest, or in some extreme cases, maybe even waiving off the agri loans. So to that extent, the clientele today is fairly, I would say, intelligent in terms of understanding that the waivers are limited to the farm loans and not really any other personal loan or vehicle loan or MFI loan that you've taken. So to that extent, our pitch, and we ensure that all the center meetings essentially clarify this point back to customers in the center format, explaining to them very clearly that the credit record at the end of the day is their responsibility. Right? If they do not pay, it's going to show up in the credit bureau record. And once they pass 90 days, you essentially become a non-performing asset where no formally regulated institution will essentially give you a loan. So that's the way we manage. One is the additional communication and clarification to the customers to say these are agri loans, not really microfinance.
How do you view the Telangana HC order on MFIs?
Very, very positive. I would say, Raghu, that is really, it's really been a case that the sector has been engaged with the judiciary right from 2010, when the AP ordinance got converted to an AP Act. And I'm very happy to sort of inform all of you that not only did we win the case, but in a separate ruling in the Supreme Court, where one of our group associations had actually filed a case between a customer and an NBFC and an issue similar to what we have gone through in Andhra. The Supreme Court has been very, very clear in terms of its ruling to say any body corporate which is licensed by the RBI, either as a bank or a non-bank, essentially will come under the RBI, and we cannot have dual regulation. So if you're under RBI, RBI will frame the rules and regulations. And if you've been licensed by the state government, which essentially means a society, a trust, or let's say, a cooperative, then whoever is licensed essentially will regulate. You can't have cross-regulation. So the question there was that what do you do then if there is an issue with an RBI regulated institution that a state wants to flag off? So again, the Supreme Court has been clear there to say you need to write to the RBI to say these are the instances where we found that this particular entity has violated some norms, whether it is on responsible lending, collection practices, recovery practices, and to that extent, then the RBI will do the needful investigating and taking the right action. So state laws do not apply on RBI regulated institutions. Similarly, RBI laws do not apply on state regulated institutions. That's a very, very clear judgment now, and we are very happy, I would say, that investors at large, lenders, practitioners like us are very, very thankful to the Honorable Supreme Court in clarifying this once for all. And a lot of support here has come from the RBI as well, where we've tried to explain to them that we cannot have dual regulation where it then becomes completely complicated and you don't know then whom to essentially listen. So we're very happy that that particular issue is now being laid to rest. The Money Lending Act, which is what most of the states essentially used to invoke, does not apply on RBI regulated lenders, which is banks and non-banks.
Manoj, thank you for taking your time out to be on our show. We look forward to having you sometime down the line.
Welcome. Thank you. Thank you. My pleasure.
If you take unsecured personal loans from State Bank of India, you may soon have to shell out more. The head of the nation's largest lender, Dinesh Kumar Khara, recently said that if the cost of his funds goes up as the RBI increases risk weights, he will definitely increase interest rates. But what are risk weights? Kasturi Akhil explains.
Earlier this month, the Reserve Bank of India increased risk weights on consumer loans from banks, non-banking finance companies, and credit card providers. What is risk weight, you ask? Risk weight is essentially a function of the risk perception the Apex Bank has on loans for different sectors. It applies to all categories of retail loans such as personal, home, car, and education loans, as well as corporate lending. Risk weight is capital or the amount required to be set aside by institutions stipulated by the RBI for giving loans, which is depicted in terms of the percentage of loans disbursed. The central bank increased the risk weights by 25 percentage points to 125%. This means that earlier banks needed to maintain capital of 9 rupees for every 100 rupees they loaned. But now they will have to keep 11.25 rupees. The hike in risk weight implies that banks and NBFCs will need to set aside a higher amount of capital for these loans, leading to an increase in the cost of capital. The adjustment applies to both existing and new loans. However, it excludes housing, education, vehicle, and loans secured by gold and gold jewelry, and also microfinance loans. Typically, commercial banks and non-banking financial companies or NBFCs face a risk weight of 100% for loan exposures. A hike in risk weights may lead to higher interest rates and reduced access to credit for consumers as banks adjust lending practices to meet increased capital requirements. This could impact borrowing costs, which means taking loans will become more expensive, leading to a limited availability of loans. Brokerage firms say the new move will increase the cost of personal loans and credit cards and may curb growth in these categories. On average, unsecured retail loans have seen a year-on-year growth of 23%, significantly higher than credit growth in other segments, which is 12 to 14%. Thus, this has been a cause of concern for the RBI and has also been highlighted by the regulator in the past few months. The central bank reverses risk weights for a loan category when it perceives that the risk attached to that category has elevated. Back in 2005, the regulator had raised the risk weight on banks' exposure to the capital market and the real estate sector by 25 percentage points to 125%. In 2019, the RBI reduced the risk weighting on consumer loans such as personal loans from 125% to 100%. In October 2020, the RBI rationalized the risk weight norms for retail housing loans, taking into account the criticality of the real estate sector in economic recovery.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The growth surge in unsecured personal loans seems to have caught the attention of regulators and the government. Recently, it was Finance Minister Nirmala Sitharaman who advised SFBs and NBFCs to not go too far too soon while lending. What's brewing there? I asked our banking expert Tamal Bandyopadhyay. Here's the chat.
Hello and welcome to the show, Tamal. Let's start with your this week's column, which is about bond, long-term government bond. And you mentioned that there's a positive for India. And what's the global scenario like?
Well, this is the first 50-year bond by Reserve Bank of India. And we discussed in the column that how globally, most of the OECD countries have between 30 and 100-year-old bonds. And then the column also talks about the countries which have gone into it in the recent past, meaning I'm talking about in the last decade, towards the end of last decade, when the interest rate was probably all-time low for most of the countries, Austria, or there are multiple names there. So those bonds came in the picture, Israel, Mexico, Peru, even Argentina, and many more. But what happened is this, as the interest rate rose, which happened early this year and from next year on, from last year onwards. So the bond investors had to bear huge losses because, as you know, the bond yield had been rising till recently. And as the yield rises, the price goes down. So that's a problem. Apart from the credit risk, which turns NPA when borrowing account, the interest rate risk, which hits you hard in the bond market, that has happened in the recent past. But Indian story is slightly different because in our case, the inflation is not that high, which most of the other developed countries faced. And also the hike in interest rate is much more, I would say, moderate than the other countries. So in this context, and of course, our economy has been growing, the fastest growing economy we are talking about by 2028 or by 2030 became the world's third largest economy. So in that case, it's a good step by the Reserve Bank of India to have a 50-year bond, because what happened is this, I would say this is helpful for the government because the gross borrowing program does not rise too much. You can continue with that kind of stuff, long bonds. And the insurance companies, particularly the pension funds, when we are talking about insurance for all, and they need long-term investment. And so in that context, long bonds is an excellent platform. And of course, it will encourage the corporations also to get into the longer format of this kind of instrument, which will, for infrastructure financing, etc., will come in. So overall, I would think when the rest of the world is struggling with the long bonds, in Indian context, it's the appropriate instrument that the banking regulator has introduced. I wish it would have even come early. Should have come.
Right. So let's stay on the topic of financial markets. Now, last week, RBI Deputy Governor Rajeshwar Rao said, and he talked about the banks of tomorrow. So what are your thoughts on that?
No, that's, he touched upon a very critical, important and sensitive issue. The banks need to change themselves. Now, we have been often discussed that do banks need to behave like a tech companies? Do they transform into tech companies? But that's not the case. Most bankers feel that because banking is all about trust. Banks takes your money and my money. So I would not trust a tech company. So which means what? The banks must be run by the banker, but the infrastructure, the logistics of banking, as well as the customer-facing part of it, even the internal part of it, both has to be technology-driven. So that's the new reality. In fact, Rajeshwar Rao spoke about how the banking will become could soon become a service which will be offered by others as well. So essentially, the role of technology. So that's the important part, and that's the very real part. I mean, as you know, that particularly the non-banking space, we are seeing all the use of technology and the loan apps, etc., which will help you. It's another story. It sometimes has been misused, but there is no escape from the technology part. And the bankers and the banking industry, or rather the entire lending industry, to prepare to face the new reality. There is absolutely no escape.
Right. So a lot to think about there, of course. And of course, another thing that we've been a lot thinking about and talking about is lending. The latest was Finance Minister Nirmala Sitharaman telling and advising SFBs and NBFCs to not go too far too soon. What do you think is happening there?
No, Swapnil, if you have noticed in the recent past, when I'm talking about the last 15 days, both the banking regulator as well as the finance ministry have been issuing concerns and to some extent warning also against the irrational exuberance in lending, particularly in one space, the personal, unsecured personal loans. Now, we have been talking about personal loans up to 50,000. We have been talking about personal loans about 10,000. Around 10,000, but even 500 and 1,000 and 2,000 rupees kind of loan with some of the loan apps. Now, to make a correction, if the loan apps are not certified or approved by Reserve Bank of India, it's the NBFC. If you are a bank or an NBFC, you can have your loan apps, right? So some of those NBFCs, the loan apps, I understand that they're giving loans for 500 rupees. Now the question is, where is the money going? Is this money going to buy pizza? Is this money going to buy some medicine? Or is this money going to play gaming apps, etc.? There you speculate and make more money, or getting into stock market. And as we speak, last week the IPO is so close to 4 trillion rupees. Those IPOs gathered. That's kind of subscription sale. Now we are talking about negative liquidity in the system, and there the IPO is drawing 3.8 trillion money. So where is the money coming from? So I think if the concern is right, both by the ministry and Reserve Bank of India, probably the money is not being used for the purpose for which it is meant. Probably the money is being channeled into speculative activities like the gaming and stock market. Earlier it was crypto, so on and so forth. So if indeed that's the case, then it needs to be tightened, which is why Reserve Bank of India raised the capital requirement from 100% to 125%. And I would like to believe that probably there will be more steps coming in to rein in, because particularly what's happening in the NBFC sector, some of the bigger NBFCs are getting into the game of arbitraging. They are taking money from banks, passing on to the smaller NBFCs. All sorts of things are happening. And this is the classic irrational exuberance.
Right. So caution.
Right.
Right, indeed. And caution indeed is important, is what you are saying. So thank you so much. Thank you so much for joining us, Tamal, and sharing all this with us. Thank you.
So the regulator is quite clearly placing a premium on caution. On that note, do you feel safe while using banking apps? That's what we asked you last week. 65% of you said yes, you do feel safe while using banking apps, while for 35%, the answer was no. Here's our question for this week. Do you expect the RBI to reduce the repo rate? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We'll be back next week with more news, views, and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.